What if I told you that the global economy is standing at a silent turning point right now, and the next 1 month could quietly decide whether the world moves towards stability or slips into another slowdown? There is one economic indicator that has sent warnings before every major crisis in modern history. Before the Great Depression, before the dot-com crash, before the 2008 financial crisis, and before the pandemic recession. And today, that same indicator is sending a signal once again. What makes this moment different is not the signal itself, but how calm everything looks on the surface. Stock markets are hovering near all-time highs. GDP growth numbers still appear healthy. There is no official recession announcement. Because of this, many people believe there is nothing to worry about. But history tells us that the most dangerous economic turning points often arrive when things appear normal. To understand why the next few weeks to 1 month are so important, we need to talk about the yield curve, what it really measures, and why it may be misunderstood right now. The yield curve is one of the most reliable macroeconomic indicators ever created, but only if it is understood correctly. At its core, the yield curve measures the difference between long-term interest rates and short-term interest rates. Long-term rates are decided by financial markets and reflect expectations about future economic growth and inflation. Short-term rates, on the other hand, are set directly by the central bank, in this case the Federal Reserve. When short-term rates are lower than long-term rates, the yield curve slopes upward. This is considered normal and healthy, because it encourages banks to borrow short-term and lend long-term, which fuels investment and economic growth. When short-term rates rise above long-term rates, the yield curve inverts. This signals restrictive monetary policy. Credit becomes expensive, lending slows, and economic pressure begins to build. Every major recession in the last century has been preceded by an inverted yield curve. That is why economists pay such close attention to it. About 1 year ago, the yield curve did something very specific. After staying inverted for one of the longest periods in history, it moved back above zero. This process is called yield curve steepening. Many people assume that the danger ends when the inversion ends, but history shows the opposite. In 1929, the yield curve steepened shortly before the Great Depression began. In 1989, 2001, 2007, and 2020, the same pattern occurred. The inversion happened first, economic pressure built quietly, and the recession arrived only after the yield curve began to steepen again. That delay is exactly why the yield curve confuses so many people. It does not predict immediate collapse. It signals that monetary conditions have reached a breaking point. Now here we are in late 2025, roughly a year after that same steepening signal, and yet there is no officially declared recession. Markets are strong. GDP growth is positive. This has led many commentators to argue that the yield curve is broken. But the real question is not whether the indicator failed. The real question is whether the economy is behaving in an unusually delayed way. To answer that, we need to understand how the yield curve interacts with the labor market. If we look at historical data going back to the 1980s, the yield curve and the unemployment rate move very closely together. When unemployment is high, the Federal Reserve usually adopts a stimulative monetary policy. Interest rates are lowered, the yield curve steepens, and lending expands. This supports economic recovery. When unemployment is low and the labor market becomes tight, the Federal Reserve worries about inflation. To slow the economy, it raises short-term interest rates. This flattens or inverts the yield curve and restricts credit. Eventually, this pressure leads to a slowdown or recession. This pattern has repeated over and over again. Importantly, this relationship has not disappeared today. In 2022 and 2023, inflation surged while the job market was extremely tight. In response, the Federal Reserve implemented one of the most aggressive tightening cycles in decades. Interest rates were raised rapidly, pushing short-term rates above long-term rates and deeply inverting the yield curve. This was intentional. The goal was to slow demand, cool inflation, and weaken an overheated labor market. As expected, this restrictive policy eventually began to show effects. By 2024 and into 2025, unemployment started to rise. Historically, when unemployment rises meaningfully, Recessions usually follow and are later confirmed by the NBER. What is unusual today is that the unemployment rate has risen by around 1 percentage point without an official recession being declared. This has never happened before in the same way. At first glance, this situation looks similar to periods before past crises, especially the years leading up to 2008. Unemployment was rising, the yield curve was steepening, and many believed the economy would stabilize. Eventually, it did not. However, today's environment has a critical difference that helps explain why markets have remained resilient. To see this difference, we need to compare the unemployment rate with initial jobless claims. Initial jobless claims measure how many people are being laid off and applying for unemployment benefits. In previous recessions, rising unemployment was accompanied by rising jobless claims, signaling widespread layoffs. Today, that pattern is missing. Jobless claims have remained relatively stable even as unemployment has risen. This tells us that companies are not laying off workers at the same scale as in past downturns. This divergence reveals something important. The unemployment rate and jobless claims measure different things. The unemployment rate counts people who are actively looking for work. Jobless claims track people who have lost jobs. It is possible for unemployment to rise without mass layoffs if hiring slows dramatically. This is exactly what appears to be happening now. Companies have largely frozen hiring. People who are already unemployed remain unemployed longer, and new entrants into the workforce struggle to find jobs. This pushes the unemployment rate higher without triggering layoffs. From a corporate perspective, this is an efficient strategy. Firms reduce costs by avoiding new hires while protecting existing productivity. This is also why corporate profits have remained strong and stock markets have continued to rise despite a weakening labor market. However, this situation creates a fragile balance. Hiring freezes cannot last forever. Eventually, companies must choose between restarting hiring or moving into layoffs if demand weakens further. This is where the yield curve becomes critically important again. Right now, the yield curve is sitting very close to zero. This means monetary policy is neither clearly stimulative nor clearly restrictive. It is balanced at a pivot point. Small changes in interest rates over the next few weeks to 1 month could have outsized effects. If the Federal Reserve cuts rates further, the yield curve could steepen meaningfully, making borrowing cheaper and encouraging investment. This could extend the economic cycle and delay a recession. If inflation reaccelerates and forces the Fed to pause or reverse rate cuts, the yield curve could flatten or reinvert, increasing the likelihood of an economic downturn. Many people ask why the Federal Reserve does not simply stimulate the economy and remove all recession risk. The answer lies in the Fed's dual mandate. The Federal Reserve is responsible for both maximum employment and price stability. It must balance the risk of rising unemployment against the risk of persistent inflation. If inflation remains too high, aggressive rate cuts could cause prices to surge again, damaging long-term stability. This is why the Fed moves cautiously. One useful way to visualize this balance is by comparing unemployment and inflation together. When inflation is high and unemployment is low, restrictive policy is justified. When inflation cools and unemployment rises, stimulative policy becomes appropriate. Today, inflation has eased from its peak, but has not fully disappeared. This limits how aggressively the Fed can act. From here, there are two broad paths. In the first scenario, inflation stabilizes or continues to decline. Falling energy prices, especially oil, play an important role here. Oil prices are a major input cost across the economy and strongly influence inflation. Recently, oil prices have been trending downward, which reduces inflation pressure. If this trend continues, it gives the Federal Reserve room to cut rates further. In this case, over the next 1 month, monetary policy could gradually become more supportive. This would likely improve hiring conditions and reduce recession risk in the short term. However, it would also encourage speculative behavior in financial markets. We have already seen signs of this in elevated valuations and increased risk-taking. In the second scenario, inflation surprises to the upside. This could be triggered by supply shocks, geopolitical tensions, or renewed demand pressure. If inflation rises again, the Federal Reserve would be forced to pause or reverse easing efforts. This would keep financial conditions tight and could push companies from hiring freezes into layoffs. In this case, the delayed effects of restrictive policy would finally surface, and the economy could enter a more traditional recession. Which path becomes reality will depend on data released over the next few weeks, not years. That is why this moment matters so much. It is important to understand that the yield curve is not predicting an immediate crash. It is signaling risk accumulation. The absence of a recession so far does not invalidate the signal. Instead, it suggests that this cycle is behaving differently, possibly because of unique post-pandemic dynamics, fiscal policy, and corporate behavior. But even delayed signals eventually resolve. The economy cannot remain in a frozen state indefinitely. Either growth re-accelerates sustainably or underlying weaknesses become visible. For investors and everyday people, the key lesson is not fear, but awareness. Strong markets today do not guarantee stability tomorrow. At the same time, warnings do not guarantee immediate collapse. The yield curve tells us that the system is under pressure and approaching a decision point. The next 1 month will help clarify whether that pressure is released gently or stored for later. History shows that ignoring these signals has rarely ended well. So, where does that leave us right now? It means we are in a period where surface-level data looks fine, but deeper indicators suggest caution. It means policymakers are walking a tightrope between inflation and employment. And it means that the calm we see today should not be mistaken for certainty. Economic turning points are rarely obvious in real time. They become clear only in hindsight. I am curious to know what you think. Do you believe the economy will achieve a soft landing this time? Or do you think history is repeating itself in a delayed form? Let me know your thoughts in the comments below. And if you find value in clear, logical explanations of complex economic issues without noise or hype, staying connected will help you keep up with what comes next.